Okay, chapter 4, where we're going to complete the accounting cycle. So we got most of the way done through it in chapter 3 when we did the adjusting entries, and now we're going to close things out. So the first part of this chapter, we're talking about financial statements. And this part should be fairly easy because we talked about these in chapter 1. So we always do the income statement first, and then the statement of owner's equity, and then the balance sheet. And we have to do these in this order, right? Because we need the net income to give to the owner, and then we need the new capital balance to put on the balance sheet. Now, so far we have been doing what's called an unclassified balance sheet. And we've been using what's called the account format. That's what we've been looking at so far. What we're going to add in this chapter is we're going to break this down a little bit more into a classified balance sheet in the report format, which would be more what we would report out to other people. Like if you look on websites at the financial statements for big companies, that's what you'll see as the classified balance sheet in the report format. And when we say classified, we break things into break it down into a little more categories. So instead of just assets, we'll have current assets and long-term. And instead of just liabilities, we'll have current liabilities and long-term liabilities. So that's the main difference. So current generally means I'm going to use it up in less than a year if it's an asset. So those would be things like cash, accounts receivable is going to get paid soon, office supplies, things like that are going to be used up fairly quickly. Any of those prepaid assets are probably current. Long-term is greater than a year. So these are for assets, things that are going to be used for multiple years, like your equipment, your property, your land, your trucks, things like that. With liabilities, current are things that are due within a year, and long-term are things that are due in longer than a year. So like if it's a 10-year note payable or a 30-year mortgage payable or something like that, that would be long-term. So this is what we have been looking at. This is what we've seen before. We do the income statement first, revenue and expenses. We take that expense then and we give it, or that net income, and give it to the owner. The statement of owner's equity tracks the change in the capital account. So what we started with, plus what we added in, minus what we took out, the withdrawals, and we get the new capital balance. And that new capital balance, sorry, I just can't get that in the right place. The new capital balance then is what goes on to the balance sheet. We have our assets, liabilities, and owner's equity, and we know that total assets has to equal total liabilities. And again, this is the unclassified balance sheet that we have been doing. So if we want to take this and put it into a classified balance sheet in report format, these numbers are all the same. These are the same balances in these accounts. All of these numbers are the same. Total liabilities and equity, total assets are going to be the exact same numbers. We're just going to have a couple more subtotals, if you will. All of these numbers are coming off our trial balance or off our ledger accounts. And so we're going to take the same numbers, but this is the report format. And this is a classified balance sheet. So you can see cash, I'm going to switch over here. Cash is broken into, assets is broken into current assets and plant assets. And so here's my total current assets, and you can see the types of things that are in there, prepaid things, accounts receivable, supplies, and of course cash is always in there. And then here's my plant assets, and those two together equal my total assets, which is the same as my total assets were on the unclassified. Now let me talk about the long-term assets just for a minute here. Long-term assets fall into three categories. One is the plant assets, and these are things that you're using to produce whatever it is you're producing. These are productive assets. So your equipment, the land that your building is on, your building, all these things are necessary to do what you do. Trucks to deliver your stuff, whatever it is you're doing. The second type we see is long-term investments. So these are assets that I own, but not for the purpose of producing what I'm producing. So if I buy a piece of land, the land, for instance, here that my building is on, that's productive, I'm using that. But if I buy a piece of land and I don't ever intend to use it for my business, I'm just holding it until the value goes up and then I'm going to resell it, that would be a long-term investment. Or if I buy an antique truck that I'm not ever going to use as part of my business, that might be a long-term investment. But a truck that I use for delivery would be a plant asset. And then the third type is intangible. These are things like copyrights or patents. And then the other one you see in there is called goodwill. This is kind of the difference between what the company is worth and just the sum of its assets minus its liabilities. So for instance, if you're looking at two restaurants and one, the assets, the building, the equipment, the kitchen equipment, all that is about the same in the two of them. But one's brand new and has only been around for 6 months, and the other one has been in business for 50 years and has a really loyal clientele built up. The one's worth more than the other. The one that's established and has the established clientele is worth more. And the difference there is goodwill. Now, in a big company, this is generally it's you know, you can't just make this number up. Oh, I've got $6 million in goodwill and put that on your balance sheet. You have to be able to justify it through, like if it's a small business, maybe through the real estate value of it, you know, the price you could get for it. In a big company, it's generally the stock price. So if I take my assets minus my liabilities, that's what the physical amount is worth. But then if I look at what the stock price is trading for, the difference between the two is the goodwill. So then with the liabilities, I got my current liabilities and I've got my long-term liabilities. So here's total current, here's long-term, and the two together are this. And then are the total liabilities. And then again, liabilities plus equity gives me total liabilities and owner's equity, and that is the same number that I had over here. So it's the same numbers, all the account balances are the same. It's just I have these new kind of subtotals here, you know, total current, like that. And so basically I'm just breaking these into current and long term. But other than that, it's the same as what we've been doing. So here's a couple problems that we are using the trial balance, the adjusted trial balance, to do the financial statements. The first one, of course, we always do is the income statement. And if I have everything on my trial balance in order, these are all right here together, right? Oops. Here's my revenue, and here's all my expenses. And so right here, this is all what's going to the income statement. So all I'm doing is copying these same balances over and making it pretty. Here's my total revenue. Here's my total expenses right here. The sum of these four expenses. Revenue minus expenses equals net income. And I'm going to give that to the owner on the statement of owner's equity. So again, all of these numbers just came straight off the trial balance right here. Just copied these numbers straight over. I list my expenses biggest to smallest, with smallest being biggest to smallest. Then we take the same thing, they want us to do the statement of owner's equity. So what I need on the statement of owner's equity, I need the beginning capital balance, I need the withdrawals, plus I need the net income from the income statement, which we said was $5,100, I think. So then I have what I need to get the statement of owner's equity. Here's my beginning balance. There were no contributions, and I added net income. Here's what I subtracted. So what I started with plus what I added minus what I subtracted gives me my ending capital balance, and this is what will go on the balance sheet. So the third part here just asks us to do an unclassified balance sheet. That's what we did before. So again, everything's grouped together, right? Here's my assets, here's my liabilities, and then I don't want this capital number, right? I want my new capital from the statement of owner's equity. which I said was 17.2. So everything on the balance sheet will come from the trial balance except for capital. And so here's my unclassified balance sheet. Again, all of these came from the trial balance. All of these came from the trial balance, except this came from the statement of owner's equity. And so my total assets equal my total liabilities and owner's equity and owner's equity. But everything else comes from the trial balance. So once I've done that adjusted trial balance, the work is done, right? I'm just putting them in a more readable format here, but all the numbers I'm just carrying over with the exception of the capital. And then before we do that one, I just want to do a quick exercise here on which category of the classified balance sheet. So our categories are current assets, and then in the long term, we have the plant assets, we have the long-term investments, and we have the intangible assets, and then we have current liabilities, we have long-term liabilities, and then we have the equity. So office supplies, I'll use those up within the year, so that'll be a current asset. Interest payable will be due within the year, so that'll be a current liability. Capital is obviously part of the equity account. Copyrights would fall under that intangible asset. Tangible. Land would be part of your plant assets. Plant is also sometimes called property, plant, and equipment, which helps you remember what's in it, but those are all what we call plant assets. So the land that my building is on and all my equipment is on is still productive, so that is a plant asset. Accumulated depreciation. If I'm depreciating this asset, then it's clearly going to be used for more than a year. I wouldn't depreciate it if it's a current asset. So this has got to be part of my plant assets. Land held for long-term investment purposes. So this isn't the land that my building is on, so this is long-term investment. Unearned revenue, that's a current liability. And notes payable due in 6 years, the fact that they told you that, you know it's a long-term liability. You see payable in the name, you know it's a liability, and if it says 6 years, you know it's long-term. So after a little practice with those, we can go back to our original problem here and do the classified balance sheet. And again, I want the assets and I want the liabilities. And I'm not going to use this capital. I'm going to use the 17.2 that we calculated from the statement of owner's equity. Owner's equity. Other than that, everything will be the same. We just have some more categories. So it looks like this. So here's my total current assets. I have one plant asset minus the accumulated depreciation gives me my total plant assets here. So my total assets are 22.7. I have two current liabilities and I have one long-term liability. So my total liabilities are here. So this one and this one gives me total liabilities. And then here's my new owner's equity. So everything came off of the trial balance except for this one. Except for the capital, that came off the statement of owner's equity. And so now these two here must equal, right? My assets must equal my liabilities plus owner's equity. But if we go back to our old balance sheet, 22.7 total assets, 22.7 total liabilities and owner's equity. So there's nothing too new here. It's just, adding some additional classifications. And then the last thing I want to show you, and then I'll probably break it in a new video, is the worksheet. So everything here in blue is what we did in the worksheet at the end of the previous chapter, on chapter 3, where we had the unadjusted and then we had the adjustments. And so we had one debit and one credit for each adjusting entry. and then we calculated the new balances in all of them and got the adjusted trial balance. Once you get to this point, the work is pretty much done. Now here, again, debits have to equal credits, debits have to equal credits, and debits have to equal credits here. Now the last two statements here are sections 5 and 6, are the income statement and the balance sheet. But really all I'm doing is I'm carrying these balances to the income statement section, and everything else I'm carrying over to the balance sheet section. I'm not doing any math here, I'm just copying those balances straight over. So these guys get copied over to the income statement column, and the rest of them get copied over the balance sheet. Everything's grouped together in order, so you just take them over in sections. And I haven't done it, I just copied those exact same balances over. So, I'm trying to see if I can zoom in here a little bit. There. So nothing earth-shattering here, just copy those balances straight over. If it was in the credit column over here, it's in the credit column over here. If it's in the debit column over here, it's in the debit column over here. Now, what I want to point out though here is that the debits do not equal the credits, and I wouldn't expect them to. Because if this is, the total of the credit column is my total revenue, and the total of the debit column is my total expenses. So the difference, my revenue minus expenses, is my net income. And so that goes right here. And once I fill that in, now my debits equal my credits. So over here, these two have to equal. Now if I look at the balance sheet section, these two are also off, but they need to be off by the same amount, okay? And the reason they're off is because on the statement of owner's equity, I said, okay, I'm going to take this net income and I'm going to give it to the owner. And so it'll get credited to the capital account, but I haven't done a journal entry to do that yet. So that money hasn't actually been added to the ledger account for capital yet. And so eventually that'll be credited, and that's why this is on the credit side. These guys are on the outside because revenue was bigger than expenses, or credits were bigger than debits. And so that means I have a net income. But if I had a net loss, they would be on the inside. It would be a credit over here and a debit on the balance sheet side. Because if it was a net loss, I'd be subtracting that from capital, which is a debit. And so they have to match each other in this column, and they're either going to be on the outside together or on the inside together. But in the end, once I put that number in, my debits and credits equal on the income statement, my debits and credits equal on the balance sheet. And I think once you do this in the homework, well, that'll make a little bit more sense about what I'm saying about the inside and the outside. But this number has to be the same for both sections. It's just the opposite. It'll be a debit and a credit, or it'll be a credit and a debit. I'm pointing to this with my finger, and you can't see that. Sorry. So it'll be, one has to be a debit and one has to be a credit. So that is the worksheet. And again, I think that'll make a little bit more sense when you're actually doing it. So I'm going to cut this off here so it doesn't get too long, and then I'll come back with the closing entries.